You might be sitting in your living room right now, just looking at the walls around you and seeing nothing but drywall and paint.
Right, just the physical house.
Exactly. But structurally, or I guess financially speaking, you are actually sitting inside this massive high-capacity battery.
I love that analogy. It's so true.
Yeah, and for the last few years, as the housing market has just shifted in these really unprecedented ways, that battery has been, passively charging up in the background.
Storing up all this massive financial power.
Right, in the form of home equity. In today's deep dive into the source material, which is the Homeowner's Guide to Strategic Equity Management, really reveals just how many people are plugging into that power source right now.
The numbers are honestly staggering when you look at them.
They really are. Our mission today is to figure out exactly how to navigate this hidden wealth without making a critical financial misstep. Because, according to the text, in just the first quarter of the year, homeowners extracted a massive $47 billion in home equity.
$47 billion. That's
Yeah.
wild.
I know. It's the highest first quarter total we've seen since 2021.
The sheer volume of capital moving out of residential real estate and, into the broader economy is just remarkable.
Yeah.
We're basically looking at a scenario where everyday individuals, without changing their income streams or their savings habits at all.
But of just living their lives.
Right. They've suddenly found themselves with access to tens or sometimes even hundreds of thousands of dollars in stored value. And it's simply because of the aggressive appreciation in the housing market since 2020.
Okay, let's unpack this. Because if everyone is pulling out this cash, the $47 billion figure proves that accessing the capital isn't the hurdle, right? Like the capability is clearly there.
Oh, definitely. The money is flowing.
So the tension the guide introduces is really about the deployment of that capital. What should you actually do with it? Because when someone realizes their home battery is fully charged, there is this overwhelming psychological urge to treat that stored power like a windfall.
Yeah, like you just won the lottery or something.
Yeah, exactly. But it's not a lottery ticket.
No, it's not. But it feels unearned in the traditional sense, You didn't clock in for overtime to get it.
Right.
So that cognitive friction we normally associate with spending our hard-earned cash, it just isn't there. And the text spends a lot of time analyzing this exact borrower psychology.
Which is super dangerous.
Super dangerous. The danger really pops up because people start viewing a highly leveraged financial tool as free money.
Yeah.
They use it to fund everyday consumption or lifestyle inflation or these really short-term experiences.
I was actually thinking about the mathematics of that while I was reviewing the source notes. Using your home equity for a vacation, for instance, is a bit like putting a luxury cruise on a 30-year payment plan.
Oh, that is a perfectly terrifying way to put it.
Right. You're basically paying interest on a sunburn you got a decade ago.
Yes, because the long-term math is incredibly unforgiving. When you extract equity for consumption, you're taking a depreciating experience.
Like a trip or a wedding.
Yeah, or even a new car that loses value the second you drive it off the lot. And you are financing it with collateralized debt that is tied directly to your primary shelter.
Your home. The place you sleep.
Exactly. The memory of the vacation fades in a few weeks, but the amortization schedule stretches out for decades.
It's crazy when you think about it.
It really is. Those interest payments are actively eroding your future wealth building capacity. Equity is a tool, not free money. The source makes a very clear division between those risky everyday expenses and strategic reinvestment.
You're systematically draining the battery to power a single light bulb for an hour and then wondering why the house is dark 10 years later.
That's spot on. The guide draws a very rigid line here. It categorizes expenditures into either draining the battery, like you said, or upgrading the battery's overall capacity.
Upgrading the house itself.
Right. What's fascinating here is how the source details a very specific list of value-adding reinvestments. We're talking kitchen renovations, bathroom updates, roof replacements, impact windows, and outdoor living improvements.
Stuff that actually stays with the house.
Exactly. The underlying logic from the text is that these aren't just expenses. They are tactical actions that simultaneously increase the home's value and the homeowner's day-to-day quality of life.
It fundamentally changes the appraisal value, doesn't it? You aren't just sinking money into a black hole. You are actively forcing the property to appreciate.
Yes, forced appreciation. And furthermore, you are mitigating future risk.
How so?
Well, the text points out that upgrading to impact windows, for example, often triggers a pretty substantial reduction in your annual homeowner's insurance premium.
Oh, right. Because the house is safer.
Exactly. Or think about a roof. A failing roof is a massive liability. It depresses the sale price if you ever need to liquidate the asset. By deploying equity into the physical shell of the house, you're protecting the core valuation of the asset against depreciation.
While getting a nicer kitchen out of it.
Exactly.
Okay, so that makes
Right.
perfect sense. We avoid the 30-year sunburn, and we treat the equity as a specialized tool for structural enhancement. But even if a homeowner makes the responsible choice, say they commit to the kitchen renovation to force that appreciation, they immediately slam into a massive economic brick wall right now.
The current interest rate environment.
Yes. The mechanics of actually getting the money out seem incredibly precarious today.
They really are. The macroeconomic landscape has fundamentally altered how we access this stored wealth. If we connect this to the bigger picture, the guide introduces this major roadblock called the lock-in effect.
The golden handcuff.
The golden handcuffs, exactly. We have to look at the historical context. Over the last several years, millions of homeowners refinanced or purchased homes, and they locked in fixed mortgage rates hovering around, what, 3%?
Yeah, some even lower. And in the context of historical averages and current inflation, holding debt at 3% is just a phenomenal financial advantage.
It's an asset in its own right. It acts as an incredible shield against inflation. Your housing cost remains aggressively low, while the value of the dollar fluctuates everywhere else.
Which is great until you need to borrow more money.
Right, because the friction occurs because today's borrowing environment is drastically different. Current mortgage rates are sitting, in the mid 6% range.
Here's where it gets really interesting. Because if a listener wants to build that new kitchen, but they have a 3% mortgage, doesn't a traditional cash-out refinance force them to trade that amazing rate for today's mid-6% rates?
Unfortunately, yes.
Isn't that like trading a winning lottery ticket for a handful of scratch-offs?
It is exactly like that. The destruction of purchasing power in that scenario is just severe. The source material outlines a specific scenario that illustrates this beautifully.
Let's hear it.
Okay, let's say a listener has a $400,000 mortgage balance at that pristine 3% rate,
Nice.
and they want to pull out 50 grand in equity for that kitchen upgrade.
Okay.
If they execute a traditional cash-out refinance, they don't just get a new $50,000 loan. The bank pays off the entire original $400,000 mortgage.
Oh, wow. They wipe out the 3% entirely.
They wipe it out. Then they bundle the new 50 grand on top of it, and they issue a brand new $450,000 mortgage at today's 6.5% rate.
That is brutal.
Yeah.
So your monthly servicing costs just skyrocket.
Far beyond what you would expect just from borrowing an extra 50 grand. You are voluntarily surrendering one of your most valuable financial shields.
The interest paid over the life of that new loan would completely cannibalize any value you added to the home with the new kitchen.
Completely. You're effectively paying a massive premium on money you already borrowed years ago. The guide is adamant that homeowners have to avoid that specific maneuver unless there is a catastrophic emergency.
So what's the solution then? How do you get the money without killing the 3% rate?
To bypass this trap, lenders in the text recommend subordinate financing.
Like second mortgages.
Exactly. Specifically, home equity lines of credit, the EEOC, and fixed-rate home equity loans.
Okay, so subordinate financing, meaning it takes a backseat to the primary mortgage.
Right. The original 3% loan stays completely frozen, untouched, and totally isolated from the new debt.
Which is the whole point.
The separation is the entire appeal. With a HELOC, the bank uses the home as collateral to issue a revolving line of credit. It's much like a credit card limit, but tied to your home's equity.
So you only pay interest on the capital you actually draw down to pay the contractors.
Precisely. And the home equity loan operates similarly by protecting that first mortgage, but it delivers the capital as a single lump sum payout with a fixed interest rate.
Okay, so the guide goes pretty deep into the mathematics of how banks actually determine your credit limit for these tools. They don't just let you drain the battery down to absolute zero.
Oh, no, definitely not. They use a loan-to-value calculation, or LTV. The LTV is the critical metric here.
Let's break that down for the listener.
Sure. Most lenders cap your total allowable debt at 80% of the home's current appraised value. The text provides a great baseline calculation for this.
Okay, say my house appraises at $600,000 today.
Right. 80% of that total value is $480,000. That is the absolute maximum amount of debt the bank will allow to be secured against the property.
But I already have my original mortgage.
Exactly. So if you owe $300,000 on that primary 3% mortgage, you subtract that from the $480,000 ceiling,
Which leaves me with $180,000.
leaving you with $180,000 in accessible equity. That becomes the maximum theoretical limit for your HELOC or your home equity loan.
So the bank is basically maintaining a 20% equity buffer just to protect themselves.
Right, in case the local housing market experiences a sudden downturn.
But while keeping the original mortgage safe is clearly the primary goal, the text doesn't just let HELOCs off the hook either, right?
Not at all.
Because there are distinct mechanical risks baked into how a HELOC operates, especially regarding the timeline of the loan. The guide details this whole difference between the draw period and the repayment period.
Yeah, and this is where people get in trouble. The structure of a HELOC can create this very dangerous illusion of affordability.
How so?
During the initial draw period, which typically lasts for the first 10 years, the lender often only requires you to make interest payments.
So you aren't even paying down the principal.
Right. The principal balance remains totally untouched unless you voluntarily pay extra. So this keeps the required monthly payment deceptively low while you are doing your renovations.
But that draw period eventually has to end.
It does. The window closes and you transition into the repayment period, which usually lasts 15 to 20 years.
And suddenly your monthly payment recalculates.
Exactly. It jumps up to include both the interest and the full amortization of the principal. The payment shock can be really destabilizing if a borrower hasn't, modeled out that future expense.
That sounds like a ticking time bomb.
It can be. But the guide highlights an even more pressing variable in today's climate: the interest rate structure itself. HELOCs almost universally carry variable interest rates that are tied to the prime rate.
Meaning your monthly obligation isn't static at all.
Yep.
If the broader economy shifts and central banks raise rates to combat inflation, the interest rate on your kitchen remodel automatically climbs right along with it.
Exactly. You might pull the money out when rates are at 7% and then find yourself paying 9% a few years later. That variable nature forces the borrower to assume the interest rate risk rather than the bank.
Which is a huge burden for a regular homeowner.
It is. When you combine a variable rate in a volatile economy with that looming transition from interest-only payments to full principal repayment, a HELOC requires rigorous, forward-looking cash flow analysis.
Because debt demands continuous monthly servicing, even when you deploy it strategically for value-adding renovations.
Right. For a homeowner who is already feeling the pinch of inflation in other areas of their life, adding a fluctuating second mortgage payment might really compromise their monthly stability.
Which introduces a completely different philosophical approach that we found in the later chapters of the source material.
Yeah, the alternative route.
Right. Because if a borrower looks at the LTV math, and they factor in the variable rate risk of a HELOC, and they just decide they simply cannot stomach taking on new debt or increasing their monthly obligations, they aren't necessarily stuck.
No, they're not. This raises an important question. If the goal is to capture the immense wealth generated by the home's appreciation, but the borrower refuses to incur the costs and risks of subordinate financing, how do they unlock the capital?
Right. What's the secret door?
The guide presents the ultimate alternative: liquidating the asset entirely through a sale.
See, wait, so to get the value out of the house, you just get rid of the house.
Pretty much.
For a listener who, loves their home, maybe they raised a family in that space or spent years cultivating the garden, isn't that throwing the baby out with the bathwater?
The emotional resistance is profound, I'll give you that.
Yeah.
And the text definitely acknowledges that homes are deeply personal sanctuaries.
Right.
However, from a strictly pragmatic financial perspective, the text argues that homeowners often suffer from asset tunnel vision.
Asset tunnel vision.
Yeah. They fixate on the low 3% mortgage rate they hold, viewing it as a reason they can never, ever leave. But holding on to a low rate on a property that no longer serves your needs, maybe it's too large after the kids move out, or the maintenance is just becoming burdensome, that can literally trap your net worth inside drywall.
So the lock-in effect we discussed earlier actually works against the homeowner here.
Exactly. They become a prisoner to their own favorable debt terms. The guide actually advocates for viewing the sale as the cleanest method of extraction.
Because when you sell, you convert the stored equity directly into liquid cash.
Yes. Unencumbered by new debt obligations or variable interest rates. You are no longer paying a financial institution for the privilege of accessing your own wealth.
But you do have to account for the frictional costs of the transaction itself, right? I mean, the text breaks down the reality of realtor commissions, closing costs, potential staging fees.
Which aren't cheap.
No, they routinely consume anywhere from 6 to 10% of the total sale price.
Those transactional costs are definitely significant. But the source frames it this way. They are a one-time reduction rather than a compounding, decades-long interest burden.
Ah, that's a good way to look at it.
Once those fees are cleared, the liberated capital can be deployed with total flexibility. A homeowner might downsize to a smaller property and just purchase it outright with the cash.
Instantly eliminating their monthly housing payment.
Exactly. Or they might relocate to a region with a significantly lower cost of living, leveraging that geographic arbitrage to stretch their equity much further into their retirement portfolio.
The source material is very careful not to prescribe a one-size-fits-all mandate, though. It doesn't claim that selling is universally superior to utilizing a HELOC.
Right. It's about options.
It frames the landscape as having two distinct doors. You have the borrowing door, which lets you retain the asset while navigating the complexities of subordinate debt.
And you have the selling door, which severs your tie to the asset but delivers unencumbered capital. The true value of the text is outlining the mechanics behind both doors, so the homeowner isn't making decisions based on just financial momentum or panic.
Right, you want to make an informed choice.
Exactly. If a young professional plans to stay in their neighborhood for another 15 years because of the great school district, navigating a HELOC to build an addition is likely the mathematically optimal path.
Makes sense.
But if a retiree is holding onto a 4-bedroom house solely because they don't want to lose a low interest rate, well, selling the asset might dramatically improve their financial mobility.
So what does this all mean? When we synthesize the entire framework this guide presents, the narrative moves far beyond the initial shock of that $47 billion extraction figure.
Right.
Home equity is just this massive dormant power source. The shifting economic environment has charged your home's battery to unprecedented levels, but that power is entirely neutral until you decide how to plug into it.
The distinction between wealth on paper and functional wealth is execution. The people who will benefit most from this unprecedented run-up in housing values are the ones who deliberately map out the mechanics of extraction before they ever contact a lender.
So for you listening right now, the directive from the source material is clear. Evaluate your own goals. Do the loan-to-value math on your specific property.
Sit down and crunch the numbers.
Understand the draw periods and variable rates of subordinate financing, and guard your low-rate primary mortgage aggressively. Do not drain your battery to finance a short-term lifestyle upgrade. Always consult a trusted lender before treating your home's value as liquid cash.
The mechanics we've explored today provide a really solid blueprint for protecting your net worth. But building on the core philosophy of the text, I'd suggest looking at your physical surroundings through a slightly different lens today.
Oh, where should they focus?
Well, the entire premise of this guide requires us to treat equity objectively, right, as a mechanism for leverage. But a house is rarely just an objective asset. It is deeply tied to our identity.
Very true.
So ask yourself this. As you evaluate the financial tools available to you, are you allowing your emotional attachment to the physical structure to dictate your financial strategy? Are you taking on unnecessary debt to cling to a property that no longer fits your life simply because you can't bear the thought of selling the toolbox entirely?